Let me be very direct with you because this is where most people get misled before they even start investing. There is always a moment in every cycle when a particular market starts to feel unavoidable. You see it everywhere. People are talking about it in group chats, influencers are breaking it down in short clips, and it feels like if you are not involved, you are somehow falling behind. That emotional pressure is powerful, and most people don't even recognize that they are reacting to pressure rather than making a financial decision. They think they are being rational, but in reality, they are being pulled by urgency disguised as opportunity. The uncomfortable truth is that markets don't need to be bad for you to lose money. In fact, most people lose money in perfectly legitimate markets, assets, and opportunities. The problem is not always what they invest in, but when and why they invest. Timing and psychology matter just as much as the asset itself, sometimes even more. A strong asset bought at the wrong phase of a cycle can still lead to disappointing or even damaging results. And this is exactly what most beginners overlook because they are focused on stories, not structure. Right now, the market you're being told not to miss is likely surrounded by optimism. Optimism feels safe. It feels like validation. When you see others making money, your brain naturally assumes that participation equals success. But what you are often not seeing is the sequence behind that optimism. Early investors enter quietly, prices start moving, attention follows, and by the time the average person hears about it, the easy phase of growth has often already happened. What remains is usually higher volatility, sharper corrections, and far more emotional decision making. This is where people make a critical mistake. They interpret visibility as opportunity. The more they hear about it, the more secure it feels. But visibility is not the same as value. In fact, in many cases, the more crowded a trade becomes, the thinner the margin for error gets. You are no longer investing in fundamentals alone. You are now competing with collective emotion, expectations, and short term positioning. That is a very different game from what most people think investing is. And here is what makes it even more dangerous. When things are going up, your brain stops asking the right questions. You stop thinking about downside risk, you stop considering alternative scenarios, and you start anchoring your decisions on recent performance. It feels logical because everything around you is reinforcing the same narrative. But investing has never been about following reinforcement. It has always been about questioning it. So before you put a single rupee, dollar, or dirham into any trending market, you need to pause and ask yourself a very uncomfortable question. Am I making this decision because I understand the opportunity deeply, or because I am afraid of being left behind? Because those two motivations might lead you to the same action today, but they will not protect you the same way when the market changes direction. And it always does. Every overheated market follows a very predictable psychological pattern. And once you start recognizing it, you begin to see how little of what looks like opportunity is actually grounded in real value. At the beginning, there is usually a quiet phase where only a small group of people are aware of what is happening. Prices are stable, interest is limited, and the market is not emotionally charged. This is the stage where real accumulation often happens, but most people are not paying attention because there is no excitement yet. It does not feel urgent, so it does not feel important. Then comes the shift. Prices start moving upward, sometimes gradually at first, sometimes sharply. This movement attracts attention, and attention is the most powerful force in financial markets. Once people see upward movement, they start constructing narratives around it. They don't just see price action, they see meaning. They begin to assume that something must be fundamentally changing, that this time is different, or that a new era has started. This is where the illusion begins to form. As more people enter, the market enters what looks like a healthy growth phase, but underneath, something else is happening. The driving force is no longer just fundamentals or long-term value perception. It is now a combination of liquidity, sentiment, and social validation. People are not only investing because they believe in the asset, they are investing because others are investing. This creates a feedback loop where rising prices attract more buyers, and more buyers push prices higher. It feels like confirmation, but it is actually reinforcement without depth. At this stage, the market starts to feel easy, and this is one of the most dangerous psychological traps in investing. When something feels easy, your brain naturally lowers its guard. You stop questioning your assumptions because the outcome appears obvious. People start to believe they have discovered something simple that others have missed, when in reality they are just late to a widely shared movement. Simplicity in perception often hides complexity in reality. This is also where overconfidence quietly enters. When people see consistent upward movement, they start to attribute it to their own understanding rather than market conditions. If they invest and the price goes up, they believe they made a smart decision. If it goes up again, that belief strengthens. Very quickly, luck is mistaken for skill and timing is mistaken for insight. This false sense of competence is one of the biggest drivers of poor financial decisions. What most people don't realize is that popularity does not equal stability. In fact, the more crowded a market becomes, the more sensitive it is to shifts in sentiment. When too many participants are positioned in the same direction, even small changes in confidence can trigger disproportionately large reactions. That is why the same market that feels unstoppable on the way up can feel confusing and unstable on the way down. So when you hear everyone talking about a market, when you see constant excitement and urgency, it is not automatically a signal of strength. Often, it is a signal that emotion is now playing a larger role than logic. And once emotion becomes the dominant driver, the market stops being just an investment environment and starts becoming a behavioral one. That is where most inexperienced investors get caught, not because they chose a bad asset, but because they underestimated how powerful collective emotion can be in shaping price. The real risk in investing is often misunderstood, and that misunderstanding is exactly what leads to repeated financial mistakes. Most people think risk is simply about whether an asset will go up or down in price. They look at charts, short-term volatility, and headlines, and they assume that if something feels stable or has been rising recently, then the risk is low. But that is a very surface-level interpretation of risk, and it misses the deeper, more dangerous layers that actually determine outcomes over time. True investment risk is not just about price movement. It is about the conditions you enter into, the expectations already priced into the market, and your own ability to behave rationally when those conditions change. When a market is already heavily optimized by attention and capital inflows, the risk is no longer just external, it becomes structural. You are not just betting on an asset anymore. You are entering a system where expectations are already high and margins for error are significantly smaller. One of the biggest hidden risks is entry timing within a cycle. Two people can invest in the same asset and have completely different outcomes, not because the asset changed, but because the context changed. The first person enters early, when uncertainty is high but pricing is reasonable. The second person enters after significant attention has already pushed prices higher. On paper, they own the same asset, but in reality, they are exposed to very different risk profiles. The second investor is far more vulnerable to corrections, not because the asset is worse, but because expectations are already stretched. Another overlooked dimension of risk is psychological pressure. Markets do not only move in price, they move in emotion. When prices start fluctuating sharply, most investors do not behave according to their original plan. They react, and those reactions are usually driven by fear or greed, not analysis. People underestimate how difficult it is to hold a rational position when numbers on a screen are moving against them rapidly. This is why many investors do not fail because of bad assets, but because of poor emotional discipline. There is also the risk of narrative dependence. When people invest based on a dominant story rather than underlying fundamentals, they become vulnerable to narrative shifts. As long as the story is strong, everything feels justified. But narratives are not permanent. They evolve, weaken, or get replaced. When that happens, prices often adjust faster than people are prepared for because belief tends to lag behind reality. This delay between narrative change and emotional acceptance is where most financial damage occurs. Another critical point is that risk is not static. It changes as the market evolves. An asset that was low risk at one stage can become high risk at another simply because more capital, attention, and expectation have entered the system. This dynamic nature of risk is often ignored because people prefer fixed labels like safe or risky, but markets do not operate in fixed states. They are constantly shifting environments. So the real question is not just whether a market can go up. The real question is what happens if it doesn't, and whether you are positioned in a way that allows you to survive that uncertainty without making emotionally driven decisions. Because in investing, it is rarely the first decision that causes damage. It is the reaction to the second, third, and fourth shift in conditions that determines the final outcome. The smarter investor operates with a very different mindset from the average market participant, and this difference is not about intelligence or access to information. It is about how decisions are framed. Most people approach investing with a question like, how much can I make? But disciplined investors shift that question to something far more grounded and realistic. What am I actually being paid for the risk I am taking? This single shift in thinking changes everything about how decisions are made because it forces attention away from excitement and towards structure. When you start thinking in terms of risk-adjusted return, you stop being impressed by surface-level performance. A market going up is no longer enough to justify action. You begin to ask what is already priced in, how much optimism is embedded in current valuations, and what would need to go right for the outcome to continue in the same direction. This naturally slows down impulsive decisions because it replaces emotional urgency with analytical friction. That friction is not a barrier to opportunity, it is a filter for clarity. One of the most important behaviors of experienced investors is patience. But patience here is not passive waiting. It is active observation without emotional participation. It means watching markets develop without feeling the need to constantly act. Most people underestimate how powerful inactivity can be in investing. Not every movement requires engagement. In fact, over-engagement is often what leads to unnecessary mistakes. When you are constantly reacting, you are no longer investing based on strategy, you are investing based on noise. Another key element of smarter investing is understanding cycles. Markets move in phases, not straight lines. There are periods of expansion, periods of excess, and periods of correction. The investor who understands this does not try to force returns in every phase. Instead, they align their behavior with the environment. In high euphoria phases, they become more cautious. In low attention phases, they become more observant. This alignment with cycle awareness reduces emotional friction because expectations are calibrated to reality, not optimism. Discipline also means accepting that missing opportunities is not failure. This is one of the hardest mental shifts for most people because modern investing culture is heavily driven by visibility. When you see others profiting, it creates a psychological pressure to participate. But participation driven by comparison is not a strategy, it is a reaction. The smarter investor understands that capital preservation is just as important as capital growth. Avoiding bad decisions is often more valuable than capturing every good one. Finally, the smartest investors focus on repeatability rather than excitement. A single successful trade means very little if it was driven by luck or timing. What matters is whether the process that led to that decision can be repeated under similar conditions with consistent reasoning. This is what turns investing from speculation into skill. Without repeatable logic, outcomes become unpredictable, and unpredictability is exactly what most investors struggle with over time. So the real rule is simple but not easy. Do not invest because something is moving, popular, or exciting. Invest when the risk is clearly understood, the expectations are realistic, and your decision can survive both good and bad outcomes without emotional reversal. That is what separates reaction based investing from disciplined wealth building.